بالله من الشيطان الرجيم. أعوذ بالله من الشيطان الرجيم. بسم الله الرحمن الرحيم. الحمد لله الصلاة والسلام على رسول الله. السلام عليكم ورحمة الله وبركاته. Welcome to our second class. Can you hear me?
Yes, doctor, we can.
Okay, yes, Alhamdulillah. Very good. How was your first week?
It was good, alhamdulillah.
Alhamdulillah, very good. Getting used to the new schedule, your new lifestyle for a little while, inshallah, maybe a couple of years.
Inshallah.
Yeah, are you tired? Are you finding yourself finding difficulty in managing your time?
So far, it's good since it is online, but maybe when we start in the campus, it will be different, a little bit more challenging.
Yeah. Yes. Yeah. Especially if we finish our work like around the 3 or 3:30, and then we have to go and head to the university.
Right. The plan is to have the face-to-face class starting from next
Week.
Tuesday. So still, if you have any class on Sunday or Monday, that's going to be online. So our class is going to be face-to-face, inshallah, next week. That is the plan so far.
Inshallah.
Inshallah. All right. Now, let's start. I think people are still praying and they will join, inshallah. But I saw everybody registered. 2 new students from last class. They were not there in the last class joined. So, inshallah, we'll have a full class. We have 9 students in our class. And so far we have 6. The other 3 will join, inshallah. Chapter 2 is what we are going to discuss today, and we had an introduction to the financial statements in our last class, and we're going to take a further look at the financial statements today, inshallah. And we have 3 different topics here that we're going to discuss. The first one is the classified balance sheet. The second one is using the financial statements where we discuss ratios and what they mean, etc. And the third topic is financial reporting concepts. Now, among these 3 topics, the driest topic is this third one, which is financial reporting concept. And I have switched it around. I have brought it at the front so that we discuss this first and we get it over with, so that we can talk about the more interesting and involving topics in the second and the third part of the class, inshallah. I have posted the practice questions as well as the solutions for chapter 1 immediately after class last week. Did you get a chance to work through those?
Yes, doctor.
Yes,
Okay.
doctor.
Very good.
Yes,
Did you find them straightforward? You understand what to do and how to do, and you find the solutions and so forth? Everything is okay?
Yeah.
Okay,
Doctor,
inshallah.
I just have one question, please, regarding the exercise.
Go ahead.
In the question number 7,
Right.
expenses are incurred, and the correct answer is to be generated to generate revenues. Can you please just explain this for me, if you don't
Yeah,
mind, if you
sure.
have time?
Sure,
Thank
absolutely. I have all the time. Question number 7, you said, right?
Yes.
So, question number 7?
Yes, correct.
Okay. Let me pull that up on the screen.
Thank you.
Okay. Now, do you see it?
Yes,
Do you see
doctor.
the question? Okay. So the question says expenses are incurred. Uh, the first choice is only on rare occasions. Is that true? Do expenses
No.
incur on rare occasions? Okay. B is to produce assets, right?
Mm-hmm.
Uh, that could be true, right?
Yes.
C is
Yes.
to produce liabilities, right? That cannot be true
Yes.
because expenses do not generate liabilities. Expenses pay off uh, the cost that you have incurred. So you could be stuck between B and D to generate revenues and to produce assets, right?
Correct.
In the
Yes.
absence of D, if the D was not a choice, A, B, and C, then B would be the correct answer. But when D is there, uh, that is a more appropriate answer. The reason is in the statement, that is the income statement, there are two aspects in the income statement, if you remember, revenues and expenses.
Correct.
So the revenues minus the expenses are your net income. So the expenses, the primary purpose of the expenses is to support the revenue. So for example, if I make a pizza and I sell you the pizza, the sales price of the pizza, if it is 50 reals, and I paid 20 reals of ingredients to generate the pizza, then that expense was incurred to generate the revenue. Because I made the pizza with 20 reals of expenses, now I can sell that for 50 reals and can generate the revenue.
Yeah.
So this is the primary connection between the expenses and the revenues. Does that make sense?
Yes.
Yeah, it does make sense. It's a bit confusing to me, honestly.
It's
But
not confusing. You have to think about the statements. We discussed the
yeah,
statements, remember, right?
correct.
So
Yes.
the income and the expenses, the revenue and the expenses, they go hand in hand, right? And
Correct.
there may be other questions where a good multiple choice question is such where you are stuck between two answers and one is more correct than the other, and in the absence of one, the other would be the correct answer. So here you have to do the thinking, right?
Yes. Yes. Okay.
Okay,
Thank you, doctor.
no problem. And know that many questions that are not mathematical, uh, philosophical questions in real life do not have one correct answer, but in the exam they will. So this is how exam is not real life, but real life, as you know, all of you have work experience. It is one solution is better in the eyes of certain people and the other solution is better in the eyes of the other people. There is not necessarily one correct answer, and you cannot say that the other person is wrong. It is just your opinion or your understanding or your logic about the situation. Do you follow?
True. Very
Right.
true. Yes.
Right. So if we discuss now, for example, what is better, online or face to face? Again, it depends on your school of thought and how you feel, right, about the situation. So anyhow, let's move on. And you know, in higher level, if you do PhD and so forth, you will find that even the math in the higher level, the mathematical solution in higher levels do not have one right answer. I'm talking about mathematical calculations. Depending on which method of calculation you used, sometimes you can come with different answers, right? And this was a very revealing thing to me when I was doing my PhD. You know, half of all the courses I took was in the math department, and you know, I was amazed to see that how the mathematical solution could be so different depending on which method you feel is the better method. Anyhow, let's go back to our slides. There's a good question. It means you really paid attention to the questions and the answers. Very good. Any other questions?
Question.
Okay. Let's. Yes, Miss Ala, go ahead.
Doctor, how many questions in the exercises you said? I have one question regarding question number 10.
Question number 10.
Yeah. I
Okay.
didn't know why the answer C is the correct one.
Question number 10. Okay.
Yeah, I was
Let's go
confused.
to question number 10. Let me pull that up on the screen. Okay. Are you able to see it? Do you see the question? Now, what is your question? Why is
the returned earnings statement. Why it's number C?
C? The right answer is C. Why is it C? The
Why it's
retained
not
earnings.
C?
Oh, okay. Let's read it. The retained earnings statement shows all of the following except the amount of changes in retained earnings during the period, right? So it shows it has a beginning retained earnings and it's an ending retained earnings. So it shows the change. The causes of changes in the retained earning during the period. So we know that the retained earning increases when you have income, it decreases when you have loss, and it decreases when you pay dividend. So we know the causes, right?
Yes.
Yes, correct.
This is the time period following the one shown for the income statement. So this is what is not shown. The time period following the one shown for the income statement. This is not shown. We do not know the time period following the one shown on the income statement because it is for this entire period, right? I will come back to that. Let's go to D, beginning retained earnings on the first line of the statement. So we know that this is to be true. The first line is beginning retained earnings. We know that this is there. The time period following the one shown on the income statement, remember the retained earnings statement, right? It is a snapshot from the income statement. So the income statement shows you the time period, right? It shows you the time period for each year. The retained earning only shows the accumulated income the company earned and it did not pay as dividends, right? So we do not know any more detail about the income statement in the retained earning. But the other three things are clearly shown in the retained earning. Okay? Very good question, by the way.
Doctor, I had a question about question number 9.
Question number 9, okay. Okay.
How come the 60,000 for purchasing office equipment isn't included as part of the operating activities?
The office equipment is an asset. The equipment,
Asset, yes.
property, plant, and equipment is an asset.
Okay. So this would be
So
part of which activity? The finance?
this would be
No, no,
yes.
you will not include.
This would be investing activity. This
Oh,
would be
investing. And dividends would be financing.
dividends would be financing activity.
Okay. Thank you so much.
Okay, no problem. Any other questions? All good questions. Any other questions? Very good, which means you're working on them. Keep these questions coming, inshallah. It will clarify any misunderstanding you have, inshallah. Okay. Yes, Mrs. Ala, go ahead.
Doctor, sorry, but I have one last question.
Yeah, go ahead.
Just regarding the last lecture, what is the difference between the expenses and liabilities?
Okay. An expense is something that you pay. A liability that is something that is due, so you're going to have to pay. So for example, cost of uh, maintenance. You call somebody to do a repair in your office or in your shop, and you pay that person for doing the repairs. That's an expense. If you did not pay that expense at that time, right, then you would have an accounts payable. That accounts payable would be a liability. So a liability is something that you have to pay in the future. It has not been paid. An expense is something that is incurred immediately once you get the service. Does that make sense?
Yeah, I get it.
Okay. Now, you can have an expense and a liability at the same time, and we are going to build on this. We are going to discuss this further as we go into accrued method of accounting and so forth. So this will come. Hold this thought for now, and we will discuss this further. Yes, go ahead. Go ahead. Ms. Ala, you have another question?
No, I think by mistake, sorry.
Okay.
Thank you.
Okay. Ms. Shaista, you have a question? Go ahead.
Yeah, doctor, can we explain expense as in any value whose benefit we have already taken?
Yes, you can say that. You can say that. That is a way you can describe the expense.
Okay, thank you.
Right? No problem. Okay. Any other questions before we move into our topic for today? All good
Doctor,
questions. Yes.
doctor, actually, this is going to be my first class. I have missed the last class. So, in order to, be familiar with the portion that I have missed, so I need you to, guide me like how I can, uh, you know, be aware of the class that I haven't attended.
Right, so the videos uh, for the class is available. Whatever we did, it's available. And I'm going to show you how to get to that. If you get into Blackboard and you get to the live sessions, right? This is the window where you came, and this is where you clicked to get into the session. If you go up here on the top left that says menu and you click here and you go into recordings, you're going to find the three sections of last class. We had two breaks. So we had the first one, we took a break. We had the second one, we took a break, and we had a third one. So this was the first class, the three lectures. They're available there. The slides are available in Blackboard, and the practice questions and solutions are available. So you can bring yourself up to speed by watching the videos. And then if you have any questions, you can always email me.
Thank you, doctor.
Okay? You're most
Thank you.
welcome. Inshallah, go ahead.
Doctor, regarding the online sessions or coming to the campus to continue the learning, from the next week we will the lectures will be face to face,
Yes,
or we will
inshallah.
continue on.
No, the lectures, the instructions given by the university is that all masters and PhD classes will be face-to-face starting 1st of September, which is our next class, inshallah.
Okay, thank you.
Okay. Very good.
Doctor, I'm very sorry, but I was trying to see the video of the last lecture. I didn't find it, so maybe I missed only the first tab you tapped on. Which one was that on the blackboard?
Okay. Let me show it to you one more time.
Thank you. Just the
No
first one.
problem. No problem. So here If you go on the top left, right, that says menu, click there and click on recordings, and this is where you will find the videos.
I don't have this one. That's weird. So that's why I'm asking. Sorry.
How about the others? Do you have the other students? Do you have this menu?
To check.
Can you check, please? I only have the ones on the very far left. So I thought it will be on the Echo 360. I didn't find it earlier.
It's in distance learning.
Now you have to go to the distant learning. Then
And then you press the, on top of course room, there is the 3 lines, and then that opens up the new tab.
Oh, okay. Thank you so much. Now I got it. Thank you.
No problem. No problem. Very good. Okay. Okay. Now let's start, inshallah. What we have is the financial statements are prepared in an environment where there are standards and there are different standard setting bodies. There are different organizations that set the standards. So for example, there is this SEC. In Qatar, of course, SEC is the Supreme Education Council, which is deciding classes would be online or face-to-face, right? But in the financial statement environment, the SEC is the Securities and Exchanges Commission that has many regulations to regulate the stock market, etc. in the US. Then there is the Financial Accounting Standards Board, right? If you are not speaking, I would ask you to turn the microphone off. That would prevent echoes. Okay. The Financial Accounting Standards Board is a U.S. Entity, and it gives instructions on how the financial accounting standards should be, what should be done, and what could be done, what couldn't be done. The International Accounting Standards Board is IAE. They set rules for International Financial Reporting Standards, IFRS. We discussed two different set of rules. One is GAAP, which is US. The other one is IFRS, which is set by IASB. So GAAP rules are based on pronouncement from FASB, and the International Financial Reporting Standards, IFRS, the rules are from IASB. And then we have another entity, which is PCAOB, which is Public Company Accounting Oversight Board. They give pronouncements and rules on how a publicly traded company should act, what their auditors should do, what their auditors cannot do, what their auditors must do, etc., etc. So these are standard setting bodies. And for now, we're not going to get into too much more details on specific rules from these entities. You should know that these four entities provide different rules and regulations on how accounting and auditing should function, either in the US or internationally. You can ask and stop and ask me questions anytime. We're going to discuss a few very fundamental and important financial reporting concepts that guide the preparation of the financial statements and the presentation of the information. So here what we have in the first slide are two different aspects for the processing financial information. The first quality is relevance, and the second quality is faithful representation. So the financial information must have relevance and it must have faithful representation. What do these two things mean? The first one is relevance. That means the financial information that is given to the user of the financial information should make a difference in making a business decision. So, reporting of the sales, reporting of the inventory, reporting of the cost of goods sold, reporting on the salary expense, all of these things are relevant. They make a difference on whether you need to increase your labor, decrease your labor, charge more to your customers, etc., etc. So the information must be relevant. It must have relevance to the business decision. Under the relevance, there are three sub items. The first one is predictive value, which means it helps provide accurate expectation. For example, let's say I'm operating a shop and I am going to order inventory for the month of September. Now, I want to know how much inventory to order. I would look at last year's income statement from September and balance sheet from September to see how much inventory did we use or how much inventory did we sell. And of course, you have to factor in other factors. If your sales have gone down because of COVID-19, you would factor that in. Or if your sales have gone up because of the World Cup that is taking place in a particular year, then you would factor that in. But the information from the past should give you some predictive value. You should be able to use that in predicting your outcome. The second sub item here is confirmatory value, which is the confirmation or the correction of prior expectations. So let's say you ordered a certain amount of inventory at the beginning of August, or you predicted a certain amount of labor cost for the month of August. When the income statement of month of August comes, it will either confirm that your prediction was correct, or it should correct that your prediction was too high or too low. So the financial information either tells you that your prediction was correct, or it tells you that your prediction needs to be adjusted as you go forward. So it has some confirmatory value going in the future. The third subcategory under relevance is materiality, which is likely to influence the decision of an investor or creditor. Materiality means it is an amount or it is an item that matters, right? It is an amount or it is an item that matters. I'll give you an example. Let's say you're coming to class, you're coming to the face-to-face class, and you have parked your car and you're coming to the classroom and you're 1 minute late. You're not going to stop and you're not going to send me an email saying I will be 1 minute late, because it's not material. It's so insignificant that you're coming in at 6:01. It's no big deal. But let's say you're stuck in traffic and you feel that you are not going to make it until 6:30. So it's a significant amount. So you're going to maybe send me a message or an email saying that I started on time, but there is an accident on the highway, etc. I am going to be 30 minutes late. So now this is something that matters. So when you're reporting the financial information, anything that matters, anything that will change the decision or the action of the investor or the creditor or the customer or anybody else, it should be declared, it should be announced. All right? So far, so good? You're following?
Yes, Doctor.
Yes.
Okay. Okay, inshallah. The second is the fruitful representation, which is it depicts what really happened, meaning faithful, not fruitful. I'm sorry, I said fruitful. Faithful representation. Faithful representation means you're speaking the whole truth and you're not holding anything back, and you're not representing the fact in such a way makes it look better than what it is, or it makes it look worse than what it is. So it includes representing information completely. Nothing important has been omitted. Everything that is supposed to be disclosed, it should be disclosed. The second sub-item here is neutral, meaning it should not be biased towards one position or the other. Meaning, let's say you have decided to either launch a new product and you feel that there is a 50-50 chance of launching the new product on time, and because of that the sales may go up, etc. Should give a neutral position, the true position, not based on what you feel, what you would like to happen. It should give the true picture. It should be a neutral, not biased towards one way or the other. It should be a neutral disclosure of information. That's in the faithful representation. This is one of the sub items. And the third thing is free from error, which is no mistakes. Now, you cannot produce financial statements that are absolutely free of errors with absolutely no mistakes. It's nearly impossible. But you do not want to put any information that has big mistakes, which would make, which would change the decision of the investor or the creditor or the customer, etc. Okay, so these two things, the relevance and the faithful representation. Moving along with,
Excuse
yes,
me, doctor.
go ahead.
Actually, you had in this the last point of the faithful representation, the free from error. Actually, as you have told, in the faithful representation, the person is speaking the whole truth. So, the free from error statement is actually contradicting the definition. So, how is it a part of it? Because when a person is representing it faithfully, so he
Right,
is uh, disclosing each information.
right,
Uh, this is what is this is what a person understands from the definition. But the last
right.
point, free from error, is a bit contradicting.
Okay. Now, you understand the financial statement reporting process is a very, very complicated process which involves hundreds of accounts and dozens of people recording items and editing items in there. And complete information means, let's say you have 4 branches and you have only reported the sales from 3 branches because the 4th branch does not show that good of a profit, or you feel that one of these branches will close soon because you do not have any customers. Keeping that, holding that information is incomplete information. Okay. Free from error is all the mathematical calculations and the methods used, which are numerous, to ensure that those calculations are done diligently. Like I said, it is not possible that the financial statement is 100% free of mistakes. It's just impossible. Auditors cannot look for that. So when we issue an auditor's report, we say that we have audited such and such company, and the financial statements are free of material misstatements, meaning there is no major mistakes which, if it was corrected, would change your decision. Okay,
Mm.
so these are not contradictory, they are two different things. They're complementing each other. Complete is not withholding any disclosure, and free of error is trying to make those disclosures as mistake-free as possible.
Okay.
Okay,
Okay. Thank you, doctor.
no problem. Ms. Ala, you had a question?
No, I just wanted to clarify the difference between the both errors. But as you mentioned, what I understand, free from errors is the calculation have to be well calculated, and the other errors that the company made throughout the year, for example, and they have to fix it or they have to show it to the investors. Like, yeah, is it correct?
So two different aspects. If you're confusing between complete and free of errors, complete is disclosing everything, and free of error is disclosing each of those components without mistakes. So let's say you are producing 4 products: a computer, a television, a phone, and a tablet, and you have 4 different factories. Disclosing the income and expenses for all these 4 factories would be complete. If you did not show one of these, if you only represented 3, then it would be incomplete information. And free of error would be making the calculations in all of those income statements as accurate as possible without any major mistakes. Okay? Does that make sense? Okay. Moving along, there are certain qualities that enhance the financial statements, the financial reporting. The first one is comparability. Comparability means when you're taking 2 different companies' operations, you can compare the results because both financial statements are prepared based on the same guidelines. So you're playing based on the same rules. When I say revenues, Pepsi Cola and Coca Cola both mean the same thing when they say revenue. When they say cost of goods sold, both of them mean the same thing. When they say net income, both of them mean the same thing. So you can compare 2 companies. The second quality is verifiability, which is if you were to verify the same information independently from more than one source, you would get the same answer. So if, for example, the company calculated cost of goods sold and the auditors came and they recalculated the cost of goods sold, they would find the same result. That means the information has been verified, the information has the quality of verifiability. The third quality is understandability, which is the information must be presented in such a way that a reasonable person can understand it, who knows how to read the financial statement. It is not so unorganized or so complicated that it is difficult for an average business executive to read it. It should be understandable. The next one is consistency, which is the accounting principles used by the company should be the same from year to year. So there are certain methods the companies use, such as inventory calculation methods and depreciation methods, which we are going to learn a little bit of that as well in our subsequent sessions. But it should be calculated the same way from year to year, and there are a number of different ways of calculating. The company has to choose one. Once the company chooses a particular method for calculating inventory or depreciation, they should continue using the same method so that you can compare the results from 2 years, and you can say, okay, this year is better than the other year, or this year is lower than the other year, because the method of calculation is the same. It is in the same company between 2 different years. And the last is timeliness. The accounting information should be produced timely. If it is late, it is no longer relevant. So if you get the income statement from 2015 in 2020, that is no longer useful. Too much time has passed. So it should be as timely as possible, so that any decision you have to make based on that can be made at that time. All right? Everybody with me so far?
Yes.
Okay. Okay. The next concept is the use of calendar year versus fiscal year. So the calendar year, all of you know, starts from January 1st to December 31st. A fiscal year can be for any date to any date for a company. So if the company chooses to follow the January 1st to December 31st, then their income statement and balance sheet can be uh, from January to December. But if the company chooses to have another fiscal year, for example, a company can start operations on 1st of April of 2020 and it can end 31st of March of 2021, any day to any day. So they can start 1st of June until 31st of May. So this is fiscal year. The company has the choice of following a fiscal year that is not the calendar year. For example, our academic year is not the same as the calendar year. The academic year starts in August and it ends in July, right? So we are in the new academic year when you join the university in August, and it will end July of next year. Similarly, the companies have different fiscal years outside of the calendar years.
Doctor,
Yes.
but this year have to be 12 months, yeah? The
The
fiscal
year
year?
is, yes, the year is 12 months, yes. The year
12
has
months.
to be 12 months, yeah, absolutely. Okay. Yes, Ms. Mai, go ahead.
I just want to ask if they use this fiscal year, let's say of April, they need to use it every year the same as like a company, let's say a restaurant, or each year they can
No, they
switch
should be,
on
it should be
and
the same.
report the publicity.
It should be the same from April 1st to March 31st. If they decide to do that, then they should do that every year. Now, if the company decides to change that, the company said that from 2021, we're going to change our fiscal year from April 1st and we're going to follow uh, a different calendar year, you can switch, but then you have to continue to maintain that. So the standard setting boards would not allow you to switch the fiscal year every year, right? So if you had it for 5 years or 10 years and then you wanted to, you'd have to declare that, you have to make all of your financial records available to the investors and the customers and the bank and the government, and then it's a long process to switch. If you switch, it is possible to switch, but once you switch, you have to then maintain the new fiscal year, but you cannot change from year to year. It's a difficult process on the company, and the standard setters would not allow you to do that. Is that your question?
Yes, and to avoid, let's say, the gap in these months that we missed.
Right. So it would not be consistent, right? You would not be able to compare 2 years because one year would have 13 months, another would have 11 months. So you would not be able to compare them, right?
Thank you.
No problem. Okay. Uh, there are certain assumptions in financial reporting. The first one is monetary unit, which means it requires that only those things that can be expressed in money are included in the accounting records. Meaning, when you're looking at the income statement, it's all in reals or all in dollars, right? So it's following a particular monetary unit. It's not one, when you report the sales, it's in dollars, and when you report the inventory, it's a number of boxes. It cannot be like that, right? Ms. Mariam?
Yeah, it's the same.
You have a question?
No.
Okay, your microphone is on, so that's why I thought you had a question. Okay. The second assumption is the economic entity assumption, which states that every economic entity can be separately identified and accounted for, meaning you have a separate set of financial statement for every company and organization. You have one for Uridu, you have one for Vodafone, you have one for QP. Inside the entity, even if you have multiple divisions, then they should be reported separately as well, so that the investor or the customer or the creditor can look at them to see which section of the business or which branch of the company is doing better and which is not doing well. So economic entities, each separate company, and then each economic unit inside the entity. It should be identified separately and accounted for so that you can look at the financial statements easily. One in the assumptions is periodicity, meaning you have to divide the time periods. For example, we talked about the fiscal year. Inside the fiscal year, you can divide the time period into quarters, which includes 3 months or even weeks, right? When I worked in the US, the restaurants, for example, franchise restaurants such as Subway, Quiznos, etc., they had a weekly reporting. They needed to know how much the waste was and how much the cost of goods sold was, as the labor cost was on a weekly basis. So it depends on the need of the business, but at a minimum, every year's operations have to be reported, and then the quarterly reporting is also required in certain cases. So periodicity is necessary. You cannot just go on for 3 years without reporting the financial results. These are fairly simple concepts, so I'm going to continue. If you have any questions, you can stop me. The fourth assumption is going concern, which is the idea is that unless you know any exceptions, you should assume that the business will continue to operate indefinitely. It should continue to operate for years to come unless there is an explicit declaration that the business is going to close in the next period or in a couple of years. Going concern means if they don't say anything, that means the business should continue. It should not stop operating in the foreseeable future. It should continue its operations. Okay. Two more slides, this one and the next one, and then we're going to take a break. Mr. Muhammad, go ahead.
Doctor, are the assumptions principles?
The assumptions are part of the financial reporting standards. So they're not necessarily principles. These are given. So if they don't say anything, you assume that these are the things that are the way they are. For example, when I say sales 50,000, you automatically know that it's 50,000 riyals. Inventory 75,000, you know that it's 75,000 riyals and not 75,000 calculators. So monetary unit, it's the financial data is reporting using monetary units and not anything else, right? So this is assumed that this is how it is. Do you follow?
Okay, sir. Thank you, sir.
Okay, no problem. All right. There are certain measurement principles. Now we're talking about principles. The first one is historical cost, which is the assets purchased by the company should be recorded at historical costs. Meaning, let's say you buy a building and you paid 1 million riyals for that building. The financial statement will continue to show that 1 million riyals on the balance sheet, even if the fair value of the building goes up or if it goes down. You have a separate line for depreciation which shows the allowance for the wear and tear and the use of the building. But the original purchase price of the asset should always show on the balance sheet. So this is the historical cost principle, that whatever you paid for a particular asset, it will continue to be on the balance sheet until you sell or dispose that asset. That is historical cost. Okay, the cost should not be increased or decreased based on what the fair market value of the item is. On the other hand, the fair value is the fair market value of the asset or the liability. And sometimes you have to demonstrate what the fair value is with additional information. So for example, if you have accounts receivable, let's say you have customers and you sold 10,000 reals worth of inventory customer. So your accounts receivable would be 10,000 reals. But you feel that one of your customers will not pay and that amount equals to 2,000. So you feel that you're going to only collect 8,000. No problem. You're going to keep the receivable 10,000, which is historical cost. And then you're going to show another line that says allowance for doubtful accounts, and this would be a negative 2,000. And then you would show net accounts receivable of 8,000. Now here you see we have the historical cost of 10,000. It's showing. It's also factoring in the fair value, meaning you feel 2,000 will not be collected. So the net accounts receivable that you feel would be collected is 8,000. So this is showing a truer picture without compromising the historical cost, right? Does that make sense? The historical cost should remain there, and then you should add information to show what is fair value and what you expect to get.
Doctor?
Yes.
The allowance doubtful accounts, 2,000, you won't receive them, right? You've taken them out.
You are not sure whether you're going to receive them or not, right? So you feel, for example, let's say I have 5 customers. From each I'm going to get 2,000. But one of those customers' business has gone out of business and they don't have any money. And I know this. So I feel that maybe they will not be able to pay. To represent the true picture, I would have to take that into consideration, and I would have allowance for doubtful accounts, right? I would have allowance for doubtful accounts, and I would show that maybe they will pay. If they pay, I can adjust my financial statements, right? But if they don't pay, I am already predicting that in my financial statements.
And you're changing the accounts receivable to a lower amount.
Right. I am lowering the expected accounts receivable by putting the allowance for doubtful accounts. Right.
Thank you.
Ms. Shaista?
Yeah, Doctor, the allowance of for doubtful accounts, will it still be a part of asset?
Okay. Now the allowance for doubtful accounts is called a contra asset account, right? A contra asset account. A contra asset account is that which reduces the value of the asset, but it still shows up in the asset section. The contra asset account reduces the value of the asset, but it is shown right with the asset. Does that make sense?
Yes.
Okay. Very good. The third measurement principle is full disclosure, which requires that companies disclose all circumstances and events that would make a difference to the financial statement users. So in addition to the numbers, if there is something that needs to be disclosed to the readers of the financial statements, then that is disclosed in the footnote disclosure. And when I say footnote disclosure, or notes to the financial statements, remember we discussed this. There are certain things that are disclosed in addition to the financial statement, the notes to the financial statements, and the MD&A, management discussion and analysis. In there, information that cannot be represented in numbers are disclosed. For example, you expect one of your operations to shut down in the next fiscal year. The operations were fine, but you're just shutting it down to do something else. This information must be disclosed so that the investors and the creditors are aware that you are no longer going to make watches next year. You're going to stop making watches. So any circumstances or event that would make a difference in the decision making of the financial statement users should be disclosed. There could be a number of things, different things that come in this category. All right. The last concept is cost constraint, which means that information, when you use information, when you produce financial statement, right? There is some cost and there are some benefits. So the accounting standard setters weigh the cost that the companies will incur to provide the information, and they look at the benefit, right? And then they make the decision. So if certain information, producing it is more beneficial and it is more than what the cost is, and it is recommended to produce that information, and the standard setters would say that you have to report this, you have to produce this. And if they feel that this information will only add very little value, but the companies would have to spend a lot of money in producing this information and it doesn't really make a difference, in that case, they would not require the disclosure of the information, right? So cost constraint is the cost of producing the information and the benefits of producing the information, and the benefits should be more, and the standard setters consider that. Okay, so far so good.
Yeah.
Okay, so we are done with the dry part. Let's take a short break and we'll come back, let's say at 7:20, and we'll continue, inshallah.